Welcome to the Business SOS podcast. This is Rich Sierra, President of the Florida Small Business Legal Center. This is episode 115 of our podcast. Thank you for listening, and I appreciate all your support, especially now over 2 years now. Hope the information I provide to you is helpful to you and your business. We'll continue our conversation that we had on franchising. We left off last time. We're talking about royalties. Let me recap a little bit more about what we talked about last week. We talked about the importance of reading the FDD, the franchise disclosure document, thoroughly, which has the required disclosures that, pursuant to the federal government, that a franchisor needs to provide to you before you sign a franchise agreement. This is for your protection. I will say that these disclosures are important, but they are the basic. So, at least to give you some disclosures you got to have there, but you got to do a little more due diligence from your end. And it's also important that, in my opinion, you get the advice of an attorney if you're considering buying a franchise. You're going into a long-term commitment, a long-term franchise agreement, in some cases for 10 years. And it's going to require a lot of investment, financial investment on your part, and personal investment as well. So something like this level of commitment, in my opinion, should have some type of professional advice. So if you're looking at a franchise, my recommendation, get an attorney that can help you navigate this and help you understand it, and really give you a true picture of what it looks like, what I call behind the logo, behind all the nice things and all the sales presentation, and what it's going to look like if you're physically running this franchise. So that way you can make a determination on whether or not this is a business venture that is right for you. It must well be, but you want to have the proper advice. And we talked about some of the disclosures and things to look at, very important to look at. Obviously, how long the franchise has been around, the business experience of the management team. You can check them out as well. Litigation history, how many lawsuits have been involved in the last 5 years, and have your attorney go into those court dockets and get a little more information. That is all public record. To go in and get at least a copy of the complaint and find out what are the allegations that are made against the franchisor, franchisee, and what defenses were raised as a result of that, and how that litigation got resolved, whether it was through a final judgment or was a settlement. In most cases, settled out of court. You want to get the history of that, and that's not going to be in the FDD, but it will be in the franchise disclosure document. It will be just a summary of the litigation along with the parties, and also with the case style. We call the case style is basically the parties, the case number, and the court. With that piece of information, we can go and do a little more background check. We can do more due diligence and find out more about what happened in that case. But that's important to know. And it was looking at trends. Doesn't mean just because they were sued or they sued someone doesn't mean that you should not be involved with it. You just want to know whether this is a recurrent pattern, or it's a one-off, it's an outlier, or somebody really just did not fulfill the obligations in the contract. It happens. So you want to find that out. Bankruptcy, it's a bankruptcy history. You want to find that out as well. Any type of initial fees. We spent some time talking about initial fees. That in most cases is non-refundable. In most cases, it's a large amount. I've seen from $5,000 to $40,000, $50,000, $60,000 of initial franchise fee, and in many cases, it's non-refundable even before the person's a location is selected. So, do you want to find out more about that? And I'm not going to go into leases now. We talked about it before. But it's important that you agree to the lease agreement or the location that you're going to be running the business from, the franchise from. because the lease is going to be in your name. It's not going to be in the landlord's and the franchisor's name. It says to me, your name is going to be your lease, but the franchisor has to approve the lease. So that's very important. And we talked about other fees, and that's where we left off last week, royalties and the importance of having the proper cash planning for the business, because there's a lag time from the time that you run the credit card for the transaction to the time that you actually get paid. There's a lag time. It might be 2 days, depending what the experience of the merchant. It could be the next day. It depends. But what I've seen a lot of franchisors do is you're required to use their POS system, the system where you make charges from, and they will have access to that information online. It's a requirement pursuant to the franchise agreement. So they will know how many sales you make. In fact, you're required to run all sales, regardless of which form, how they're paid through this system, because that's where they be able to establish or calculate the royalties that you will be paying them. And it's important also to have the proper available cash there to be able to pay the franchisor when they collect that money. Because the money will come automatically from your checking account. So where I see a lot of franchisees fail is that they don't do the proper planning. The sales are coming in. Say, for instance, they're paying payroll out of that account, which is not a good idea. My recommendation is when you have payroll, get a separate account for payroll. Only run payroll through that account. Simpler, it's cleaner, it's more efficient. And that way you're not going to deal with the issue of not having enough money for payroll or having commingled that money comes out of the operations account and then you don't have enough money to pay your franchisor. And then that ACH bounces and then you get a letter of default. So see how everything kind of ties in together. Okay. Another charge you will be most likely expected to pay is advertising fee. And it could be like 1 or 2% of sales, something, nominal to an extent. But what happened is you have all the franchisees pay a certain percentage of their sales into advertising. This money helps the franchisor do some national advertising or regional advertising in order to advertise the brand for name recognition. And by doing so, then that helps your franchise because people will recognize and people go in and purchase your goods and services or go to your restaurant, whatever the case may be. But that's an additional percentage that most likely you'll have to pay. If there's initial training, which there will be, in most cases, you will have to pay a certain fee as well. And so you have to look at what other fees are involved in the franchise disclosure document. You also have to prepare that to pay a certain amount in the franchise agreements that I've seen for what is called grand opening. So, and I'll give you a restaurant franchise, for example. You have a location, you're opening brand new to the location, so you might want to have a grand opening that will bring more people in, but then the advertising expenditures will go higher simply because you're trying to get your name out. So you're required to spend a certain amount of money in advertising. And also you have people from the franchisor's office to come and help you on that grand opening. So be prepared to do that. This one is very important, the estimated initial investment. This is where many franchisees fail. There's usually a table that is included in the FDD that gives you everything from the low estimate to the high estimate, every single line item that most likely you have to spend on to open this franchise. They go into leases, they go into legal fees, accounting fees, POS system, initial franchise fee, grand opening, you name it. They're listed there. Sometimes that is overlooked. And it's important that if you're going to look at that, think that it's going to be the high end. It's not going to be the low end in most cases. You'd rather be more conservative and say, you know what, I'd rather plan that this is going to be the initial investment that I got to have. And if you spend less, perfect. But understand what is the capital requirements for the business. It's important to you to understand and make a determination how are you going to support it. But also, that initial investment may or may not include working capital for the first 3 months. How are you going to get paid? How many employees are you going to have? So you got to, when you look at that initial investment, you have to look at any additional items that were not included there to run your business. And that's where sometimes there's some miscalculation as to how much you have to invest in the company and the franchise to the reality of it when you have additional expenses that were not included there. I mean, these are estimates. They make it very clear they're estimates. There are a bunch of footnotes along the way. That's what's important for you to understand it. Now, what I've seen also happen in the past is that franchisor, in their desire, in his desire to bring more sign-up franchisees, they don't vet properly the franchisees. They don't vet them for background in reference to their skill level, their experience, and financial. And so it's important that they do that. And sometimes they don't. And what happens is somebody puts in their life savings into this franchise, and 3 months later, the business has not really taken off or given them enough cash flow to live off. And then the rent doesn't get paid. The royalties don't get paid. Then there's a lot of friction between the partners. And if it's husband and wife, it'll be a lot of friction because you're working together, living together. It turns into a nightmare, and I've seen it. So understanding that is very important, and that's sometimes overlooked. It is right there. They provide the disclosure. It's not the fault of the franchisor if you did not read that and properly analyze it. And if you go back to my previous 2 podcasts, I talked about the importance of doing a business plan. So if you're looking at a franchise, it's also good to do a business plan. Do a business plan, do the projections, the performance. How many employees? Are you going to be working that business 7 days a week or 5 days a week, whatever the number of days you're required to work, or you plan to have employees, and how many employees you plan to have? All that is important for you to know. Some franchisors will require one of the owners to work full-time in the business. So you got to find out who that individual is going to be, how many hours that individual is going to spend in the business. You will see a section of restrictions on suppliers. You will have, in order to maintain the integrity of the brand, the consistency of the brand, I think is a much better term. As you go to, they will require to use their approved vendors. Nothing wrong with that. It's just that's the way they maintain their consistency. You will use their cups. You will use their plates. You will use their branding. You will use, if it's something that is a restaurant type oriented franchise, you will use their food vendors that will provide the foods and the sauces and the formulas and the various ingredients that you will make the food to be able to sell. You cannot go outside of of those approved vendors. In some cases, and they will disclose that to you, those vendors will pay back, will give some type of remuneration for back to the franchisor. Some people call it kickbacks, but if it's included in the franchise agreement and the FDD, it's been disclosed that as an exchange for them to do business with you, they have agreed to pay some of that money back to the franchisor. If it's disclosed, at least you know about it. Okay, just be prepared for that. At whatever rates they charge. You don't have a say in how much. You have a say in the amount that you will purchase. I don't think you have a say in the rate that you will pay because that's what they're vendors. So you'll have restriction on suppliers. Now, in some cases, you will have a situation where you finance, that you will apply for an SBA loan. And that is fine. In fact, I've seen deals that the SBA looks very favorably to potential loans that involves a franchise, especially if the franchise has been around for a while and they have history doing loans with them. Because it is a proven system. They provide a structure that, in my opinion, is good for business owners. But they just look favorably at a loan coming that is going to be used for a franchise. So it's important that if you're going to you're looking to purchase a franchise with financing, that your attorney negotiates some terms that if you do not get approved for whatever reason, then that initial franchise fee is returned. It's not going to be easy to negotiate that. In some cases, they say, you better get your pre-approval first. We're not going to agree to that. In fact, it's very difficult to make a lot of changes in franchise agreements. These agreements are very airtight. It's very structured. The franchisor might have some flexibility, but in my experience, very seldom they're changed dramatically. So just keep that in mind that you might have some flexibility in terms of negotiating some terms. You're not going to have a lot. It's just the way it works. We'll talk about territory assignments, and restrictions of territory. As a franchisor has a specific area location that they're trying to sell a franchise, you need to understand, what are you selling? What is the average sales going to be? But also, within this territory, what is your target market? Who are you selling to? If it's a business-to-business type of franchise, then, as that territory has enough of the businesses that you most likely will be customers. If it's a business-to-consumer type of franchise, then you have to make a determination, the territory that you're looking at, does it have enough people there with the right income, disposable income, discretionary income, to be able to make the sale, to be able for you to make money. So, and a lot of times people don't make that analysis. They don't look at the demographic profile of that particular territory. In some cases, they live in the territory, so they're familiar with it. But there's a lot of data available to the public records. In fact, your city has a lot of data about the per capita income of your city. Your county has the information as well. The census has information as well. All that is free. that's not going to be included on your FDD. That's not going to be included there. So it's important that when you look at the FDD, also have a marketing plan or a business plan on the side as well that you do in concurrently with that, because there are a lot of questions that you will have that are not going to be answered here. If you're looking at a mall, for example, I've seen kiosks at a mall, and there's franchises there at malls. So are you going to be exclusive in that mall? We're talking about exclusivity. That goes into territory. If you're going to have, there's a large mall, you're going to have two different booths. One, if it's a territory, say, for example, a housekeeping or a maid's franchise. That's not in a mall, that's more business to consumer. So you have to look at the territory and also look at the competition for that service that is non-franchise, but also look at the income level of that area in order to make a determination or an analysis on whether or not the territory's consumer will support your franchise enough for you to be successful. Remember that they will provide you the territory. Whether you're successful or not, it's not up to them. It is up to you. So it's important to make that analysis. How's the territory? Is it going to be 5 miles, 10 miles, 25 miles? You need to make the determination on that territory that you have to make sure you have enough of a market there to be successful, but also that you don't have another franchisee encroaching on your territory as well. So those are the things you have to look at and be mindful of as well. How long is going to be the franchise? That's very important. In some cases, you might have a 5-year franchise license, and then in other cases, you might have 10 years or more, depending what the franchise agreement states. So you need to make sure that your lease agreement concurs with the franchise agreement. It's important to have that. So, for example, if you have a 5-year lease, okay, but you have a 10-year franchise agreement, if you don't have an option to extend that lease for 5 years, you only have a 5-year lease and a 10-year franchise agreement, the landlord can choose not to renew your lease. And then what are you going to do? The reverse is also true. If you have a 10-year lease, because you're very optimistic, is this going to work? And then you have a 5-year franchise agreement with the option to renew the franchise agreement for an additional 5 years. If you have not defaulted in that franchise agreement for the last 5 years, then if the franchisor chooses not to renew that franchise agreement, you're stuck with a lease. So concurrency is very important with the franchise agreement and also with the lease agreement. And they're two completely separate documents. The landlord obviously is interested to know who's coming into his plaza. So maybe a franchise is something that he's looking for. But the agreement is going to be between you and the landlord. In some cases, you may have what is called collateral assignment of lease. What that means is that in the event that you as the tenant, you're unable to fulfill your obligations with the landlord, there's an agreement between the landlord and the franchisor that the landlord will assign the lease to them and they can take over. It is done to protect the franchisor and protect the landlord as well. I've seen other cases that the landlord, the tenant is the franchisor. So they already have the location selected. That could happen in a mall, for example. They have the location already selected. They so you coming in as franchisee, you become the subtenant. Even though you still got to pay the rent to the landlord, depending what the agreement is, they become the subtenant, and then the landlord becomes the master landlord. And I'm going into a deep dive here into rabbit hole. The point is that there are many different variations on how you get that location. For the most part, what I've seen is that you become the tenant of the landlord, and there's some type of collateral assignment of lease in which the landlord can step in, either if they kick you out of the franchise and they take over the franchise, or if they if you are about to be evicted because you have not paid that lease, the landlord ends up paying that lease and taking over the location and the franchise. And there's a lot of different agreements that if you clauses within the agreement that if you default on one, you default on the other one, and that's part of the main reason that why you need an attorney helping you with these agreements, because if you have no experience doing this before, you're going to be over your head buying a franchise and getting into a lease agreement as well. And it's going to be the opportunity for failure are very high without the proper legal advice. And I've seen it, unfortunately. And these are things that can be avoided with proper planning. I think it's important for you to also, for our closest segment, if you're looking at a franchise, besides looking for legal advice, also, in the back of the FDD, it's almost, let's see which section it is. Okay. I think it's section 20 of the FDD. You have how many franchises are active, which ones are closed, which ones are open, which are projected to be open. But you also have a list of the franchisees. Everyone. At least you have their names, you have their addresses. So with a little bit of research, you should be able to contact these individuals and ask the question about the franchise you're looking at. They will tell you. You might be a fellow franchisee. In the future, you might have a support system. They can help you. They can be your mentors, and you'll mentor others along the way. But understanding from the franchisee's perspective, how do they like, being a franchisee? What type of support did they receive from the franchisor? And as I mentioned before, support is extremely important because they will guide you to, ensure success. They will train you. So you want to find out what type of support they receive and also what they like, what they don't like. How long did it take them to really get off the ground and get their investment back? What is their average sales? See if you can find a franchise that has a similar demographic makeup as to the territory, so you can compare, is this the type of success or the type of experience that I will have. So they provide that resource to you, and it surprised me the number of people that don't take advantage of that. When I asked the question to my clients when they come in with a dispute with the franchisor, I asked, did you contact any franchisees? You talk to anyone? No. If it's there for a reason. And you rather, and again, when you're evaluating a franchise, if you decide that it's not for you, that's okay. There'll be other opportunities, maybe other franchises out there that might be the right fit for you. With the management team, the support you receive, cash outlay, all that is important, and it's certainly important enough for you to get the proper advice, financial advice, legal advice, because you're making a tremendous commitment in financial investment. You're making a commitment in time, energy, money, emotional investment. If it's something that you're doing with your spouse, you're talking both of you together, it's a big commitment to do without some guidance and without people on your team that will help you, advise you to decide whether or not this is something you want to pursue. If you have any questions about this topic or anything else that I've talked before, please send me an email. My email is rich@richsierra.com. And again, as I mentioned before, a lot of this information regarding the 23 required disclosures is at the FTC Franchise Rule Compliance Guide, which is available through the Federal Trade Commission website. I will provide a link to that resource in my show notes and also my YouTube channel as well. If you want to learn more about the legal services that we offer, my website is floridasmallbusinesslegalcenter.com. If you want to watch the video of this podcast on YouTube, my channel is youtube.com/@RichardSierra. If you want to give us a call, my number is 866-842-5202. Remember that. Also, my book, if you're interested, Business SOS, 8 Common Legal Mistakes Business Owners Make and How to Avoid Them. It's available on Amazon, Barnes & Noble. You can ask for your local bookstore. Until next week, this is Rich Sierra. Remember that my goal is to help you succeed.